Hello and welcome to the August 26, 2022 edition of Watching the Tape. The most widely anticipated event this week was Jerome Powell's speech at Jackson Hole. Each year, central bankers from around the world gather at Jackson Hole in late August for a symposium, and each year the Federal Reserve chairperson gives a speech. And these speeches have historically contained some important messages or frameworks for how the Fed will approach monetary policy in the intermediate term. So let me quickly go over what you need to know about today's speech that was delivered at 7 a.m. Pacific time. First, it was a hawkish message, and let me share some quotes. The Fed's overarching focus right now is to bring inflation back down to our 2% goal. Reducing inflation is likely to require a sustained period of below-trend growth, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation. They will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain. Secondly, Powell indicated that interest rates could remain at higher levels for an extended period of time. And here's the quote. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. So why is this such a significant takeaway? Well, prior to this, investors had broadly expected that the Fed would raise rates into about early to mid next year and then start cutting again. So we're going to go to the Bloomberg terminal to show the expectation for the overnight Fed funds target rate. So this is as of August 1st, so a few weeks ago. And if we look at the bottom here, we see this chart. And it tells us that the expectation was for the Fed funds target rate to peak at 3.27% in February before declining, meaning that the Fed would cut rates next year. So let's fast forward to today. And this is live, so real time. The shape of this chart is a little bit different, and it tells us that now the market expects the Fed funds target rate to peak at 3.8% in March before kind of plateauing and maybe declining a little bit, but it's not as dramatic as it was a few weeks ago. And this is driven in part by Powell's speech, and he seems to want to discourage investors from expecting rates to come down next year. Third takeaway is that the stock market sold off significantly on the Fed's hawkish tone about fighting inflation. So let's look at an intraday chart of the S&P 500, and it is down 2.7%. The NASDAQ is down almost 3.2% today. This is a massive move. And then if we look at a treasury, for example, we'll look at the 2-year treasury. Yields did go up a little bit, maybe 5 basis points, but it really the move is has been muted since then. So if you were to lend to the U.S. government for 2 years, you could do so at a yield of 3.39%. So those are what I would consider the top 3 takeaways from today's Jackson Hole speech. If I can step back a little bit, I kind of find it amusing how closely the market hangs on every word from Jerome Powell. If you're a market watcher or a trader, you have to pay attention because even if you don't think it's important, other market watchers do, and so you don't want to be left behind. And while I'm not a full-on market watcher or day trader, I am a Fed watcher and at times a vocal Fed critic. And so while I will admit that what Jerome Powell is saying now, he is saying the right things. He's recognizing the right challenges and saying the right things about how to address those challenges. I certainly can't help but poke a little fun too. And so for that, we're going to go back to what He said last year at the Jackson Hole speech. The spike in inflation is so far largely the product of a relatively narrow group of goods and services that have been directly affected by the pandemic and the reopening of the economy. Longer-term inflation expectations have moved much less than actual inflation or near-term expectations, suggesting that households, businesses, and market participants also believe the current high inflation readings are likely to prove transitory, and that in any case, the Fed will keep inflation close to our 2% objective over time. Um, those comments did not age well. Thanks for watching. We'll see you next time.